Hey guys, Dan Darrow here from Options in Play. So, hope you're all having a wonderful day. Today's video is going to be a lesson in risk management, but not the normal way you're thinking, all right? We spent a recent option session discussing boxing options, and I think it's a great idea to go over the concept again just because it's such an important tool for option traders. Really, uh, something that I feel is totally underrated, maybe overlooked by people that trade options, and it's just something that I feel like it's really like critical to long term management strategy, long term success in this business. So just feel like it's a good time to go over it again. All right. So if you trade options, then you're definitely familiar with how awesome they are, right? First things first. But there are limitations. So the option market's only open from 9:30 to 4 p.m. Eastern time, right? And as you probably already know, a lot of stocks trade in the pre-market or in the after hours, right? So you can trade stocks early in the morning and then like after the market closes in those extended sessions. And For traders like myself that focus on a lot of like the news or the events, you've probably definitely seen a stock have a huge move in the pre-market or in the aftermarket. And if you're just in the options, then you have to wait until the following morning or when the market opens next. So, if it's after hours, then you gotta wait for the following morning, or if it's in the pre-market, then you gotta wait for the actual open at 9:30, right? So, obviously, if you're in the stock, then you could trim, right? So you could trim the position if you're long the shot or short the stock or even like cover it like entirely if you wanted to. But that's obviously not the case with options. You can't do anything. Um, and as frustrating as frustrating as it is like watching like a huge move go by and you can't really participate. It might even be more frustrating when you're in like options and you see a huge move happening maybe in your favor and you can't do anything, and then all of a sudden there's a massive reversal before the option market opens, and you watch like what would have been a potentially great trade turn into like a loser, right? You probably know what I'm talking about. I'm sure it's happened to you before. So the goal of boxing, long story short, is to use stock to trade against the option position. Okay, so yes, you probably read that right. It's using stock to trade against the option position. So using stock to lower risk of an option position. So that means that you have to be able to trade stock as well. So that's one of the caveats here. But what the goal of is it the goal is to use it to basically reduce risk, right? And the what you're going to be doing is locking in the trade, so locking in your option by using stock. If you're long a call, then you're shorting stock against it. If you're long a put, then you're buying stock against it. And for every one call, which is the equivalent of 100 shares, right? You're going out into the market and either buying or selling 100 shares to basically flatten out that option position, right? So if you're long one call, then it's selling 100 shares, or if you're long one put, then it's buying 100 shares, right? And the thing to note is that you're still going to have to close out um, the option and the stock individually. So you can't just put in like one order to close both. You have to close out the option individually and then the stock as well, right? So sometimes there could be a little slippage there just because the markets are if they're volatile, then they could be moving pretty quick. Um, So the option position has to be regular calls, so like just normal standard calls or puts. Otherwise, you're going to really change the risk profile of the trade. Okay, so what this means is that you can't box on complex strategies like flies or calendar spreads or even really like call spreads because uh, like just the nature of that strategy. you have like multiple contracts, some long, some short. So if you go out and you take stock and trade against your maybe your long position, that still leaves like the short option position in there too. So you could theoretically turn the position from long into like a short by being like double short, right? So it's a little bit more complex, but the thing to remember is that if you have like a spread or a fly or maybe like an iron condor or something like this, boxing options is going to be a lot more difficult, if not, something almost impossible. All right. All right. So, um, boxing makes sense really when the stock trades above or below the strike price of the contract. But you also need to factor in the debit paid. Okay. So yes, it's like if you have one contract and it's up a ton after hours and it's through like the strike price of your call, you might be antsy to box it, but you really have to factor in the price you paid for that call, right? Because you want to make sure that you are recouping like the net debit or the price paid for that contract, right? Um, and what you'll notice is that the more contracts you have, the more flexibility you're going to have to possibly box a full or a partial position, right? So, for instance, if you only have one contract, then you're in a tough spot debating whether to box or let it ride, right? In case there's maybe follow through the next day. But if you have multiple contracts, then you can maybe box some. You could box like a quarter, you could box like a half, you could box like a third, and then let some ride if you think that there's potential for it to maybe follow through very sharply the next day, right? Also, it's definitely important to consider technical levels when or if you're thinking about boxing, right? So um, if the stock's hitting a key moving average or a support level in the after hours, right? This could really play a big role in whether you want to box at those levels or not. Like so, if you see it hitting like a key long-term moving average or maybe like a key momentum moving average or maybe if it's hitting 52-week support or 52-week resistance, right? So these are all things that you kind of need to factor in when boxing in addition to the net debit or the price paid for those contracts. All right. So let's go over an example right here to kind of illustrate what I mean. And like I said, if you guys trade options frequently and if you follow options around earnings or other events, then you definitely know what I mean when I say like it can be frustrating to watch like these huge reversals take shape, right? And in Palo Alto, BANW. That's what the chart is up here. Recent stock to report, and this is just like a great example of to like illustrate the point of why boxing can be so critical, right? Um, so like the stock going into earnings, it looked a little bit more set up for a bearish trade. All right, it was hanging out near like some critical support. It was below a bunch of moving averages. It was a momentum stock that lost momentum, and the weekly straddle, right? So the stock closed around 200 here, and the weekly straddle was pricing in about 16 points. So if you were bearish, and hypothetically, if you had bought like a 190 strike put, which was trading for like $3.50 or so, or even like a 185 put, which was trading for like 2.25, then you probably, right in the aftermath of the earnings, you probably would have been thinking, okay, like this is shaping up well, right? Like the company had mixed numbers, their guidance was weak, and the stock got hit very hard initially, like right after the numbers came out, right? So it dropped down to just about the 180 area, hanging around 180 for 15 not for 15. So it dropped straight down, and then for about an hour, it was, definitely under pressure. For a while, it was just hanging out right at the 180 area. And, you know, whether you bought the 190s for 3.5 or the 185s for 2.25, in either scenario with the stock at 180, you probably would have been in the money, right? So thinking, okay, this is great. Like, the things are shaping up nicely. Like tomorrow it opens at 180. You can close off the open, maybe see if it keeps dropping. Maybe like you press the trade a little bit, right? But all of a sudden, on the conference call, the stock has a massive reversal higher, right? So when it was down 20, then it got back to flat, and then it traded up as much as like 15 points. And then by the open the following day, right, this thing was up almost at 220. So it was 180 right after. Your puts are looking great. And then all of a sudden it opens the next day up at 220. So a trade that had been in the money for you in the like the first hour and a half after, the next day ends up turning into a loser because of this huge reversal, and you really couldn't do anything about it, right? But now if you had boxed the put, right? So if it drops down to 180, so hypothetically again, say you had like the 190 put, or say you had 190 put, $3.50, right? It drops down to 180. If you had bought stock against that put, then you basically locked it in, and if it did reverse, then at least like the trade was locked in from your perspective, and it wouldn't make a difference if it traded higher because you boxed it down here, right? Versus if you didn't box and you're holding the 190 put, it opens up at 220 the next day, and that trade, which had been a winner in the after hours, now turns into a loser. All right. So you kind of see what I mean. I'm sure this is something that you probably encountered if you've been trading for a while, or even if you're starting out. It's a really great example, and it really highlights the importance of boxing and why it's so critical to options, just because of like the time frames and how the option market is only from 9:30 to 4, but there's a ton of stock movement, pre-market and post-market. All right. All right. So let's go here. So, just to summarize here, okay. So the major reason, so like the main goal of boxing is to lock in that large pre-market or post-market move, right? Whether it's earnings or what have you, and just really not allow the stock to have that reversal and maybe like disrupt the trade or turn a potential winner into a potential loser, like the Palo Alto example I just showed, right? Also, overnight gains and losses can definitely be more suspect, right? So the volume sometimes will be higher, but a lot of times it's lower. So in these extended sessions, the moves can be a little bit more fickle, a little bit more prone to reversals, a little bit more prone to like pullbacks or not stick the following day. So it's really important to lock in some of like these moves if you can, and boxing with stock is just a great way to do that. It's a great way to really lower your risk in the options, kind of under the radar risk management style versus just cutting risk and rolling like we normally talk about all the time. All right. So listen, if you guys like what you hear, be sure to click the link in the video description to get more info on options in play. All right. Volatility still elevated, still a ton of stocks moving out there, so there's lots to look forward to. I hope you have a wonderful night, and I'll talk to you guys all soon.